All right. What is up, traders? What's up, tycoons? Today's video, we're going to go over and give you guys a complete guide to sector rotation. As the economy expands and contracts, so do the financial performances of companies across the 11 stock sectors. When the outlook is positive, economically sensitive companies perform better and investors are prompted to buy their shares. If the outlook turns sour, investors may sell some out of those companies and swap into investments that can better weather economic downturns. This practice is known as sector rotation. Sector rotation is evidenced in basic form by comparing the long and short-term performance of sensitive, cyclical, and defensive companies. Sensitive and cyclical stocks, which are more reactive to interest rates and other economic factors, have taken advantage of favorable conditions for most of the last decade. Now, before we go any further, of course, the content provided on this YouTube channel is for informational and educational purposes only and is not intended to be relied upon as legal, financial, or investment advice. Trading in stocks, bonds, commodities, and crypto involve a significant of risk of loss and is not suitable for all investors. So be sure to read through the full disclaimer. All right, and we'll go ahead and what we're going to start off here going over is looking at the cyclical sectors percentage change and the defensive sectors percentage change. So defensive is going to be here in orange and the cyclical is here in purple. And we can see that, the cyclical sectors over the past few years, really about the past 8 years almost, this chart goes back to about the middle of 2015. We can see that the cyclical sectors are up about 119%. Right, but we see in the 2022 bear market, these were much more sensitive, right? These had a much sharper drop when if you take a look at the beginning of 2022, all right, the defensive sector is more flat, if not even slightly up, okay? So this is, a really good visualization of, the defensive sector holding its levels and, not reacting as much as a cyclical sector and the cyclical sectors during those rough times, right? Now, of course, the cyclical sectors are going to outperform when things are bullish, okay? But in those, times of economic uncertainty and bear markets, the defensive sector will, obviously be much more defensive, right? That's where it gets its name from. Now, in the 3 years since the start of the COVID-19 pandemic, however, spiking treasury rates, inflation, and a slew of Fed rate hikes have caused investors to rotate out of cyclical stocks. Large amounts of money flowed out of equities in general since the start of 2022, and though growth stocks are rebounding in 2023, they were more acutely affected last year. Value stocks typically established companies with steadier business models were investor safe havens, right? And so we have that same chart here, okay? The cyclical sectors and the defensive sectors, and you can see the defensive sectors, outperforming the cyclical sectors here, right? And then we have the federal funds rate going up. Okay, so you can see right around this time period again from January of 2022, the cyclical sectors, are down a lot more than the defensive sectors when that Fed rate hike started really happening, right? We see the 10-year Treasury rate also going up, and then we see the U.S. inflation rate, peaked over here in July of 2022. Right, so this is just more of a visualization showing you guys kind of how the sector rotation works. Okay, now cycles that trigger sector rotations, the economy goes through cycles, right? And sector rotations occur at each stage. The most common cycles that investors follow are changes in the market cycle, changes in the economic cycle, and overbought versus oversold cycles. All right, this is the market cycle. So the market cycle typically moves ahead of the economic cycle since investors make decisions in anticipation of the future. As such, the current market cycle stage can indicate which sectors will soon become market leaders. So when you have the market bottom cycle stage, what happens is systemic risk resulting from a poor economic backdrop brings the whole market lower. Investors prepare to rotate into more economically sensitive sectors, and the sectors to rotate into are going to be communication services, consumer staples, healthcare, technology, and utilities. Now, in the bull market cycle stage, what happens is the market bottom has passed and the worst is over. As economic activity picks back up, so do the share prices of cyclical stocks. And the sectors to rotate into are going to be consumer discretionary, energy, industrials, materials, real estate, and technology. And now the market top. All right. In that cycle stage, what happens is economic growth overheats and interest rates rise. Investors prepare to rotate into more defensive sectors that are less economically sensitive. Those are going to be the sectors you want to rotate into are communication services, financials, and materials. And in the bear market cycle stage, markets begin to drift from highs and economic activity slows as investors rotate out of cyclical sectors into defensive ones. Selling activity accelerates the market decline, and the sectors you want to rotate into there are consumer staples, healthcare, and utilities. This dynamic, in which the market cycle leads the economic cycle, came to fruition during both the 2008 and 2020 recessions. In 2008, the S&P 500 peaked months ahead of U.S. monthly real GDP's top. Stocks sold off in anticipation of a worsening economy, right? And we can see that here. We have the S&P in purple, and then we have the U.S. monthly real GDP, and we can see the S&P topped out ahead of that, right? And so markets tend to anticipate things in the future, and the market tends to be forward-looking, right? Now we'll go ahead and move on. And when the COVID-19 pandemic struck in early 2020, the stock market was ahead of the eight ball once again. Such is the nature of both stock prices that discount future cash flows and investors who always want to be one step ahead, right? And so, we see here it peaks. Okay, here's the real GDP, all right, and then the stock market bottomed before real GDP, right? So just kind of some visuals and some charts to explain some of the things we're looking at. More recently, equities began an extended downtrend at the very start of 2022, along with slightly negative GDP growth in the first half of the year. No official recession occurred in 2022, but as the probability of one continues to increase, investors will be watching out for equity declines as warnings of a possible economic contraction growth, even as stocks trend higher. Right. And so that's what we're seeing here. We can see that really GDP is actually still going up, but stocks are going down. And a lot of those anticipations that we were going to have a recession in 2022, and ultimately that hasn't happened yet. Not technically, at least. Now, the economic cycle is one of the other cycles. So layered underneath the market cycle is the economic cycle. Because economic data is released more infrequently and investors price in their estimates beforehand, the economic cycle lags behind market movements. That said, it can provide solid confirmation of prevailing market trends. Sectors tend to perform differently based on the current economic cycle stage. Now, in the full recession cycle stage, what happens is you have falling GDP, falling production, pessimistic consumer sentiment, you have a deflationary environment, falling interest rates, and a normal yield curve. And the best performing sectors to be in are going to be consumer staples, healthcare, and utilities. Now, in the early expansion cycle stage, what happens is you have rebounding GDP, increased production, optimistic consumer sentiment, reflationary environment, low but stable interest rates. You have a steepening yield curve. The best performing sectors are going to be communication services, consumer discretionary, industrials, materials, real estate, and technology. In the late expansion cycle stage, what happens is you have tapering GDP, tapering production, strong consumer sentiment, growing inflation, spiking interest rates, and a flattening yield curve. The best performing sectors are going to be consumer discretionary, energy, financials, and materials. And in the early recession cycle stage, what happens is you have declining GDP, declining production, weakening consumer sentiment, high inflation, tapering interest rates, and a flat or inverted yield curve. The best performing sectors are going to be communication services, consumer staples, healthcare, and utilities. Now, if we move on, all right, here's how a few of those relevant economic indicators have been trending compared to the market performance, including US GDP, consumer sentiment, inflation rate, and the 10-year, 2-year Treasury yield spread. And so we have US GDP here quarter over quarter. We have the US index of consumer sentiment below average right now. The U.S. inflation rate is above average right now. The 10-year, 2-year Treasury yield is inverted, and we have the S&P 500 levels right over here. So, you can go back and, click on this part and then see how it's affecting things currently and where we're at in those stages and in those cycles. Now, another thing is the overbought and oversold cycles. So lastly, overbought and oversold indicators can be used to own in on an investment decision with added precision. A relative strength index, which is the RSI reading of 70 or higher, indicates a security is overbought. And a value below 30 indicates it's oversold. In April of 2022, the value-focused consumer staples sector, which is XLP, triggered a common overbought signal when its RSI reached nearly 74. The ETF slid 12.3% in the 1 month following April 20th. Conversely, XLP rallied 15.7% in a span of 60 days after the RSI hit 23.7 on September 30th, right? And so we can see here we have the relative strength index here, okay? And then we have XLP, the sector up here as well. And you can see when the RSI came down really low into that 23 level, all right? And then very shortly afterwards, it started rallying. Over here, it was overbought on the RSI, and that's when we saw that sharp decline as well. So that's what they mean by, overbought and oversold. The RSI is one of the most commonly looked at, indicators there are out there. Now, RSI readings coupled with the 200-day simple moving average encounters can provide additional signals that a sector is overbought or oversold. Take, for instance, the growth-focused consumer discretionary sector, XLY. It reached levels of resistance when the ETF rose to its 200-day SMA in both April and August of 2022. Investors promptly rotated out of XLY both times, and the sector most recently flashed signs of that same pattern at the end of January 2023 when it tested the 200-day simple moving average again. Incorporating technical indicators into sector rotation analysis is known by many as the marriage of technicals and fundamentals, right? And so if you take a look here, all right, we can see the 200-day simple moving average here in orange, and then we have overbought conditions on the RSI, and we see a strong pullback, all right? Over here as well, we go slightly above the 200-day simple moving average, and we are at those overbought conditions, and we end up getting another pullback. So, that's kind of what this chart is really trying to show you guys and tell you guys. Now, sector rotation in practice. One argument for using a sector rotation strategy is that the share prices of companies within each sector tend to move in the same direction. This is a natural effect of sector classification, whereby companies with similar business models are grouped together. At a minimum, investors can gain baseline exposure to a given sector's sensitivities using individual stocks, or broader exposure can be secured using sector ETFs. An example is the relationship of crude oil prices with major airliners, American Airlines, Delta Airlines, Southwest Airlines, and United Airlines, as well as the UPS and FedEx. Despite operating in different industries, these industrial sectors companies all benefit from lower oil prices, causing share prices to move higher when fuel costs decline. Investors use a top-down approach and look to macroeconomic indicators to assess the current economic cycle stage. Once favorable sectors are identified, rotations are made out of unfavorable ones and into those that are poised to grow. Some of the other factors to consider are sector rotation involves active management, which requires frequent monitoring of market and economic events in order to capture opportunities. As explained earlier, the economic cycle takes longer to catch up to the market cycle, and markets could also fail to digest economic news efficiently. Misstemming the market cycle could cause alpha or returns to be left on the table. Remember, rotating out of a given sector involves selling shares, and each profitable sale triggers a knock on the door from Uncle Sam to collect capital gains tax. Tax events can diminish overall returns, which is why the level of active portfolio management should be considered in order to avoid unnecessary capital gains tax. Also, keep in mind that industries aren't as homogeneous as broader sectors, and a deviation can throw off a rotation strategy. Using the previous example, low oil prices are a major tailwind for major airlines, but other industrials like railroads might suffer as crude oil shipments decline. It might be thought that a rising tide lifts all boats, but there could be outlying industries that fail to swim, reinforcing the need for thorough investment research, such as a full top-down approach. Finally, past performance isn't always indicative of future results. Even if a chart historically shows declines after securities peak and growth following a trough, economic and market events could alter those trajectories. Now, if you're interested in some sector rotation focused ETFs, you can take a look at the following, right? We have AESR, we have RORO, FCTR, SECT, QVOY, RHRX, we have FISR, XLSR, and then there are some sector rotation mutual funds as well. We have ATCIX, ATACX, CRTBX, QAISX, and NAVFX. So that's pretty much it for today's video. Hopefully you guys enjoyed it. Hopefully you understand a little bit more about sector rotation, and maybe this is something for you that you want to focus on, or maybe this is something that you want to try to avoid and just keep things simple and just constantly dollar cost average into, a broad-based ETF. Whatever works best for you, smash that like button and subscribe to the channel if you guys are new.